Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither SellStockWorld.com, PSW, nor its affiliates nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment security or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides educational and training services that are meant to teach you the risks and potential rewards of trading options. We are not a service that tells you what to trade. We are not implying or guaranteeing any profits. As always, do not trade with money you can't afford to lose. Past performance does not equate to future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any losses you may incur as a result of the information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone. All right, fantastic. Are we ready to rock and roll? I shall share my screen. All right, let's see. Did I do everything I'm supposed to do? Yes. Just make sure. Hang on. Oh, wait. Yep, okay, just make sure you're talking in the chat box if you're talking, and make sure you're talking to all participants so that I can see what's going on. What is this? There we go. All right, and I will now share my screen. Hopefully there's nothing bad on it. All right, let me bring my chat box back up so I can see what you guys are doing. Fantastic. Okay, can you guys see my trading screen? I can wait. Thank you. All right. So where are we? This is the wrong view. Let's take a look at this view. It has been a crazy day. These guys aren't set up right yet. Okay, so basically we had a big sell-off in the morning, and we flatlined out. Here we were early. We went zooming up, though, after 10 o'clock, flying higher. Doesn't show up so well here. But, I mean, you know, this is the overview. So we closed yesterday at, you know, about 4 o'clock, closed at kind of a disappointing low right here. Drifted all night. Then we went flying down this morning. This is like 1:30 in the morning, 2 o'clock in the morning until 5. Bottomed out at 5, drifted along there all the way until the open, 9:30, 10 o'clock, almost, you know, about almost 10:30, and then up like a rocket at 10:30 in one mighty shot. And then boom, 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 we've been drifting ever since. This is just the same nonsense we're seeing every day. It's just manipulated bullshit on the markets. It's meaningless. You know, mostly we're on the sidelines. We really haven't been doing many trades or anything like that. Although I did just send one out, so we'll talk about that. And Chrissy says, to get started, I was confused by the SLV trade. I think she means SLW. Selling the ITM call at 18. My premise on the play is that 18 is a good floor, so no harm in establishing a position by selling the SLW. 18 call for 280, and then using that to play the 20-25 bull call spread at 170, leaving a net 110 credit. I'm pretty sure I must have meant puts. I hate to tell you. Yeah, Pat says typo. I'm positive. I'm sure that meant puts. Let's take a look. So that's a trade from what? Yesterday, is that? SLW. All my days kind of blend together, but I imagine it was yesterday. Yeah, here's to see the 18s at 257. These 18s are $5, so I couldn't have been talking about those. So I'm sorry, I did mean the puts in that particular thing. And when did we do that? Nobody caught that apparently from chat. Oh, what is? Oh, that's not the right thing. There it is. So the assumption is this is something from yesterday. Hang on a minute. I know we can talk about SLW today. Here we go. So we were talking about SLWs. I said I like them long term. I don't know when they'll recover. So we wanted to do a conservative play. Yeah, I said calls here. I meant puts. That's what the problem is. So in context, I would hope it's understandable. So my premise on the play is 18 is a good floor, which means establishing a position by selling the SLW 18 puts for 280, and then using that, which is what we normally do, obviously, and then selling the 2025 bull call spread. That gives you a net of $1.10, and then your worst case is the 1690 entry, net credit of $1.10. So I like that kind of play. So that's the explanation there, is it was a put. Never overestimate, as she says. Well, no, that's my fault. I should have said put, but nobody caught it. That's the problem. Nobody corrected me. But I think that's unfortunately because most of the people in chat know I mean this. I have this sort of, that's my special kind of dyslexia, is I tend to write puts when I mean calls and vice versa sometimes. But conceptually, I mean, that's a very standard trade we do. We establish a base at which we don't mind owning the stock, so we don't mind owning it at 18. So we're going to sell these calls for 280, and that means we're going to sell these puts for 280, and that means that we don't mind owning the stock for $18. So that means that's free money. That means we got 280 for nothing. I got 280 for promising to do something I would want to do anyway. Because it took, I wish I had bought at 18, right? I missed it. It went up here, it shot up, and I didn't sell. Although I think we did actually. I think we have in one of our portfolios. But in other words, that's the point. It wasn't like, well, this is yesterday. So here it was at 20 yesterday. And all I'm saying is, look, we missed the 20, we missed 18, but we say, oh, I wish I would have bought at 18. Well, then all you got to do is sell the $18 put, and all they can do is give it to you for 18. So since I consider that not any kind of penalty whatsoever, I'm happy to sell the puts, and that means the money for me, the 280, is just a bonus. It's free money. So now I can take that 280, and now I can start speculating on a position. So I'm going to use a little part of that, only $1.70 of that money, to buy the 2025 spread. So 2025, 2 years from now, I can go get to 25, be back up around here. I'm not even betting it goes all the way back up. I'm just betting it goes up to around here in a couple of years. And if I get that spread, I'm going to catch, I still have my 110 credit in my pocket. And then we have the rest. So that's very nice. It's a very nice, simple, fairly conservative way to play it, because my worst case scenario is not even 18. My worst case scenario is 1690 is my assignment. 1690 is roughly here, where it was the November low, which lasted like 10 seconds before it spiked back up. All right, so that's a great way to go for things. All right, back to charts. All right, talking about the markets. Here we are. Here we are, all green again. Oh, this market is sickening to play. It really is. It's just ridiculous. I mean, it's the joke. It really is. I mean, look at this thing. Here's the Russell. So, okay, here you go. So here's 16. Here's Friday's close at 12:30, right? Monday, yesterday, up to 12:40, back down to 12:30 at the close, which is where it closed on Friday. Then today, all the way down to 12:15, and now back to 12:30. It's gone nowhere, technically, for the last few days. It's flatlining, but it's flatlining in such a way as to blow out the people who are short and then blow out the people who are long. They're trying to shake everybody off. It really is getting crazy. I mean, that move is, it's insane. It's as if there's no, and you're talking about, It's called the Russell 2000. There's 2,000 small cap stocks in this thing. You're talking about 2,000 stocks just randomly going up and down 1%, 1.5%. Just completely pointless movement. And not over in kind of long periods. You're talking about, you know, in theory, when you have 2,000 stocks in an index, it shouldn't be so volatile. This is up and down. This is a 2.5% move from here to here. It's 2.5% top to bottom in 24 hours without any particular news. And you know there's no particular news because it bounced right back, and now it's going to go back up 2.5%. So that'll be 5% worth of moves in not even 2 days. That's crazy. And what it means, though, is that these values are meaningless. And this is an index. If you think about the individual stocks, they're completely meaningless. When you can't get 2,000 stocks to behave themselves, no individual stock's going to behave itself. You're completely at the whim of like random occurrences in the market. You know, not to say that's not fun, because sometimes first of all, it increases some of the volatility of the internal volatility of a lot of stocks. Even though the VIX is low, you still get some nice volatile numbers from stocks. Well, frankly, like what we were just looking at on SLW, that's a really good number. Getting paid a couple of bucks to short the 18 puts is good money. That's like 20% of 18, and 18 is already $2 below the price is 10%. So you're getting about a 30% discount on SLW just off the put sale. So, you know, please bring it on. We're not complaining about this. It's not a bad thing, but it's crazy. You got to recognize it's stupid. Don't knock your head against the wall trying to figure out why. It's no point. It's just a ridiculous, manipulated market going up and down randomly. Or not randomly. I mean, somebody has a plan, but it's not our plan. All right, Craig says, are you looking for an end-of-day sell-off for us to play, or perhaps it was a rocket high? I got no clue. Honestly, there's no play. That's exactly right, because it's completely out of control. It's at the whim of whoever has their finger on the biggest button, and it goes up and it goes down, and it swings up. You know, from this line. What I would tell you is, yeah, if we're up at 1240, I want to short. If we're down at 1215, in fact, we did. I just called for a long down here. You know, when we're down here, I want to go long. When we're up here, I want to short, and I want to do that until it breaks. Same thing for the S&P. Here's 2100 again. I like shorting at 2100. All right, we got burned here. This 2110 is a better shorting spot, but 2100 is a nice line to short. What I want to use it for now is we want to watch and see if it does provide a barrier here, and if it does, then we might want to short the Russell because it's a better mover. Oil pop. Now, oil, I pointed out this morning, if I can find it. Where is it? This morning we were talking about the oil, and I pointed out, this is our member chat room if you're not a member. Well, I think everybody is because this wasn't a public seminar. No, where was it? Was it earlier? I'm sorry, it must have been yesterday. All right. When I say morning, sometimes I mean the end of yesterday's chat because we have these discussions early in the morning. What the hell? There we go. Gold, oil. Oh, okay. See what I was saying this morning? Check out oil. It's making the same bullshit move as last Tuesday. Last Tuesday is May 5th. Here's what happened May 5th. Flat, okay, flat line, then up at about whatever time that was, early in the morning, went up pre-market, and then it went up further. What happens here? Flat, up pre-market, the same exact, see this little thing here? The same exact move right there, then another stick up. But what's the difference? The difference is a bit more pressure today as expiration is closer. That's what you're seeing here. It was harder for them to get up because this expiration date is closer. They got the same sort of move. It went up, have a sell-off, then they regroup and punch it as high as they can. But as high as they can today was only 61. They couldn't get it to 62. You know why? This is because we're a week closer to the contract rollover, which is coming on the 20th, which is what, next Wednesday. And that contract rollover means they have to dump a lot of barrels. So we'll have to keep an eye on the barrel count, which currently is, I don't have that on this screen, but I'll take a look. Still 239. They've done nothing to get rid of barrels since yesterday. So they have 239,000 open contracts. That means yesterday they made no progress at all getting rid of barrels. So today they're gyrating. They're trying to push over 61. They're not going to make it most likely. That's going to then, what happens? So then into the inventory report, right? They're going to keep it flat up here. They're going to try again tomorrow to push as high as they can. No matter what the inventory report says, they're going to act like it was the greatest thing on earth and push it up. And then we can short the crap out of it again. So we have a game plan for oil. That's pretty easy, right? And yeah, at 61, I'm still shorting because I can short with conviction at 61. If it goes to 62, I'm happy to double down and average 60.50. Let's see. So anyway, so this conversation we were having we have all kinds of interesting conversations in the morning. 6:29 a.m., all right? So you have to get up early to do these trades. So it was at 6:29 a.m. that we were watching this happen, and we were talking about just what bullshit it was. It was the same. It is the same pattern as last week. Flat line up, tops out, and goes back down. No, that's gold. Sorry, I'm sorry. This one. Flat lines goes up, tops out the next day, goes back down. Flat line up. It's going to top out the next day and go back down. We'll watch it tomorrow. We'll double check on this chart tomorrow and see how it's going. But I'm guarantee you, it's going to look pretty much exactly the same. So I'm sorry. Somebody's asking short at 61. Yeah, short at 61. But if it goes over, probably you don't want to ride it. You want to stop out if it does go over because they're going to have a chance to punch it up to 61.50, 62. Who knows? So it's, it could be painful. So I don't want to be too cavalier about doubling down on it. When I say I would double down at 62, it doesn't mean I would stick it out over 61. It means that if I happen to miss it and spiked up on me, I wouldn't cry. But obviously, I'm not going to, if it goes up and I have a chance to get out, I'm going to get out. Because once it's over 61, there's not a lot of resistance going higher. All right, so. Okay, Chrissy says, you mentioned earlier about inflation would buoy all the indexes, and therefore you were bullish overall in the market. I don't understand this. Did I say that? I guess I might have. Okay. Inflation deflates the value of the currency. If I was, a share of IBM is a fixed thing. It's like a Bitcoin. It's no different. I mean, it's an artificial instrument, but there's a certain amount of them, and it can't be counterfeited. You actually own something that does something. So it has a value like a commodity that is going to be affected by the currency. So if the currency is worth less, it doesn't change the share price. The share price remains the same, and you need more currency to buy the shares. So inflation inflates everything about the stock. So what happens with inflation? There's a couple of different kinds of inflation. There's the kind of inflation we have now from the Fed, not that there's much of it, but we have top-down inflation. They're stuffing money into the top, and then rich people are buying art. Obviously, I think you're seeing a lot of examples of that. Rich people are buying art, they're buying houses, they're buying yachts, they're buying expensive cars, blah, blah, blah. They're buying watches. So rich people are buying rich people stuff. And they're putting some inflationary pressure on the market, but not much because, there's only so much, other than Chris Christie, who seems to have eaten $300,000 worth of food on the Jersey taxpayers' expense report. It's very hard for a rich person to eat a lot more food than the average person. Right? Maybe twice as much, 3 times as much. But quantity-wise, you can't consume that much more food, no matter how rich you are. Quantity-wise, you can't burn that much more gas. So when you have a system that's making everybody poor and a few people rich, like we are now, what happens is the demand for goods and services diminishes. It doesn't go up. Okay, in other words, if I'm a poor person, I can't afford to go to the car wash and get detailing, right? So I can't make those people busy. When I'm a rich person, I can totally afford to go to the car wash and get my car detailed, but I still only have one car, maybe two cars. That doesn't make up for the 25 poor people who can't afford to go. So their business suffers, okay? You have to think about the net effect on all these businesses. Now, on the other hand, though, if I'm One Direction and I only have, and I'm going on tour and I'm playing places where they have 20,000 tickets, and I play 10 stadiums with 20,000 tickets, there's 200,000 tickets, right? Well, how many rich people are there in the world? Forget the world. How many millionaires are there in America? In America, there's, I don't know how many. I don't want to say, it seems like a big number. How many? Oh, look, One Direction. How many millionaires in the world, in the city? There are 12 million millionaires in the world, and probably about a third of them are in America. 34 million, what do they say? So this is very important to know so you can figure out on economics to get an idea of how much people are. Which countries have the most dollar millionaires? Oh, I see. We have 41% of all the millionaires, all right? So out of 34 million people, so in America, there's a good 20 million millionaires in America, okay? 20 million. All right? So when you think about it, when One Direction goes on tour, and they've got 200,000 seats to sell, there are 20 million parents who can afford to buy them for their kids at whatever the frick price they want to charge. So you have to understand the businesses that you're investing in and who they're serving, because that's not a bad business. So you might initially say, oh, well, some stupid band, that's not a good business. It's a great business because there's less tickets than there are potential buyers. That goes to like small batch cars, like Porsches and things like that. They only make so many Porsches, so they're going to sell them all. They're going to sell every one they make in a given year. It really is a matter of how many they can make. But then when you have something that's more mass produced, it's not going to help them, like Fords and things like that. It helps a little bit because there's easy credit on cars. That's a bad example. But for homes, let's say, okay, luxury homes are selling out. There's plenty of people who can afford luxury homes. So again, you got to keep remembering this number. There's 20 million millionaires in America. 20 million. It's like, almost 10% of the working population is millionaires, basically. That's huge. They can afford a lot of stuff. They can afford all sorts of things. And then if you subdivide that, and you think about out of 20 million millionaires, how many people are, and by the way, when they say millionaires, it's people who have at least 1 million. Not an average of 1 million, that's people who have at least 1 million plus. So then you go to the next level and you say, okay, well, how many people have 10 million plus? How many people are super rich? Well, there's probably 1 million of those guys. And then how many billionaires are there? Then you cut that number down by a tenth or less. Well, let's say if you get to $100 million, probably, so you say there's 20 million millionaires, 2 million 10 millionaires. There's probably 200,000 people with 100 million plus, and then there's 1,000 or so billionaires. When you get down to the bottom of the pile, when you get to the top of the heap, actually, you have about 1,000 billionaires who can afford anything. So as long as you can create a proper desire for something like an Apple Gold watch for $10,000, right? And as long as you say, realistically, I'm only going to sell 1 million of these things, you probably are. You're not going to sell 10 million of them, but you're going to sell 1 million because there's easily that many people who could afford that watch the same way that you would go to Swatch and buy a $40 Swatch watch. It makes as much difference to them as it makes to you. So that's what we start off talking about, inflation. That's how money works. There's a certain amount of money in the world, and it's hard for you to see when you're not in that class. It's hard to understand how it all works. I used to go to this country club, and the membership of the club was $50,000 a year. So the people sitting in this club paid $50,000 just to be able to be there. and they go once a week. It costs them $1,000 a week to be at this club. Didn't include the food. Not only didn't include the food, but they had to spend a certain amount on food to be in the, to be in the club. They got to spend $20,000 on food and beverages over the course of the year, or they're kicked out for not being a productive member. And the reason they do that is to get them to bring more of their friends, because rich people have rich friends, and then the rich friends go and eat nice food at the club and sit there, and hopefully they're going to plunk down some money for membership. But it's freaking insane. But you know what that is? They do that so that these 500 guys who belong to this club can, to themselves, have a golf course where any time that they want, any time, day or night, whatever, it was lit at night, they get to just go play golf. Whenever they feel like it, on a course where the waiting time is never more than a couple of players. And the food and the chef is always there, and they're paying for these amenities that are just at their beck and call. Oh, there's a new one up in Vermont that sounds fantastic. I got to go check it out too. I forgot the name, but there's a super duper luxury place in Vermont that sounds great. So the point is, though, that there are people who don't care what things cost. And they drive this top-down inflation, and so they suck up all the expensive homes. And it causes inflation down the line because they're taking they'll knock down an entire apartment building that used to house 20 people, and they'll not 20 people, 20 families, and they'll turn into like one place that has 4 families for themselves, for themselves and their friends. That causes inflation, so it diminishes the supply of housing, blah, blah, blah. But that's a very bad kind of inflation. That's not demand-driven, okay? It's demand-driven by scarcity from the top. The good kind of inflation, and this is the kind that's going to happen soon, the good kind of inflation is from the bottom up, and that's like wage inflation. And it begins when you hired everybody, which we have. We've almost gotten to essentially full employment in this country. I know it doesn't feel like it, but we have started hiring to the point where we're running out of people to get jobs. In fact, if you walk around, you see help wanted signs, which, up until this year, really, up until Christmas, I don't think I've seen a help wanted sign since 2007. So we're running out of people to work. They actually need to find people. And when you start running low on people, you have to offer better benefits, more wages, so on and so forth. So that kind of stuff comes back. That puts more money in circulation with the people who actually spend it. They start driving the demand for goods and services, and that's beneficial, and that's called bottom-up inflation. That's good for the market. It's good for stocks and so on and so forth. Now, even though prices climb, when prices climb, see, the bad kind of inflation we have now is when prices climb, the most manufacturers cannot pass it on to the consumers because the bulk of the consumers have no money. If you service the top-tier people, you can pass on your price inflation. Bottom-tier people, you can't. And so that hurts the margins of these companies because they're still making stuff, but they can't pass along their increased costs. Bottom-up inflation, when it comes from wages, is demand-driven, and it's easy to pass on price increases when you're in that kind of market. Also very good and bullish overall long-term. So that's how inflation is good for the market. Certain kinds of inflation are good for the market, not the kind we have now, but the kind of inflation we have now, since it's the top-down inflation that we have now, because the rich people have so much money, though, they're able to buy a lot of stocks. Stocks is one of the things they buy with their money. That's causing stock inflation. It's got nothing to do with the value of the stocks. It's got everything to do with just the scarcity of the stocks, and that's driving prices up. And somebody said short oil 61. Oh, we had that conversation already. Where is oil now? 60.50. How nice. All right. Sandra says she has no sound. Okay. Try rebooting Sandra. I would tell her not to talk to me privately, but that doesn't help. Would that even work? Wait. Oh, yeah, that worked. Okay. Craig says, look like all start at 60.50, so the game plan laid out. Yep. Jim says minimum wage jobs nobody wants. Yeah, well, it's minimum wage jobs nobody wants, but the point is those people aren't available for work. They are available, but you know how it is. It's like if you're working a crappy job, you're working a crappy job. You're not filling the good job. It's hard to kind of look for the good job when you're filling a crappy job. So for the employers, it's getting a little bit harder to find good people to work. And that means they're starting to like increase their prices. I mean, look, you know, Walmart, was it Walmart? They didn't start it, did they? So, well, whoever it was, somebody started with they're raising Starbucks and other people. People are starting to like say, okay, we're going to raise the minimum wage, right? You know, voluntarily, even though it's not really voluntarily, because there's enough of a surge in Congress and you know, the people are demanding higher minimum wages. It's going to happen whether individual companies want to or not. So these companies are getting in front of the ball and acting like they're being nice, and they're raising their wages. They have to. That's just the way the market is. You can't keep your workers because, you know, the guy who's working the crappy job is going to walk off the crappy job and go get a good job, but then the crappy job guys have no one to replace him with. You know, and that's, you know, to some extent they've gotten spoiled also. Here's another thing. Here's another thing about the economy that's interesting. You got baristas at Starbucks and stores and shelf stockers at Walmart who have college educations. They just weren't any good jobs for them coming out of college. They got these people who are really overqualified for the kind of jobs they're doing. As we start getting better jobs and those people leave, the problem is the guy that Starbucks gets to replace the college graduate is not a college graduate. I don't mean college means everything, but I'm just using an example of a qualified worker. But the guy who is the guy who is a good, hardworking college student who could have gone on to better things at Starbucks is leaving Starbucks because $15 doesn't cut it, and he's going to go get a real job as soon as one opens up. Then Starbucks has to go replace him, but when they're replacing him, they're scraping a lot closer to like they have to go for like the McDonald's crowd, you know, to try to get the McDonald's store people. And those people just aren't that good by comparison. So when you look at it in the overall company, let's say the guy they get to replace the college kid is only like 80% as good. 80% as good is not bad, but you know what? When you're a great big company and you have 1 million employees and you have 80% as good, it means you have to hire 200,000 more employees because the 1 million employees are now 80% as good as the ones that you had before. And that puts pressure on wages and the economy and hiring and all sorts of things. This is what happens in job cycles. It's something people don't really realize it. And one of the reasons we don't realize it, though, is because people don't like to talk about it. Because even me, I don't usually care what I say. You don't want to say, like, idiots or whatever. You know, it's like you're hard to compare one person to another. But the reality is some people are better at working than others. That's all there is to it. And the more people you hire, the closer to the bottom of the barrel of the labor pool you have to go to pull your workers. And by the way, there's another huge thing there is training costs. You know, it's been years. It has been since 2008. There hasn't been hardly a company in America that has had to worry about finding qualified people to work for them. That lowers. So what they've done is they've eliminated their hiring departments. Okay, they haven't had to worry about hiring. They've cut, and I know my brother's in the he's a job placement consultant. He works for a headhunting firm though. It's a little more high end because he places people in a very specialized field, but he knows all about the industry. And he was telling me like these guys are hurting badly because who needs to go to a personnel, you know, to a headhunting firm to get candidates when all you got to do is put a sign up and 2 seconds later you have 100 resumes. That's not happening anymore. But meanwhile, all these personnel agencies have gone out of business, so they've cut back their staff. And the HR people, you don't have the teams that interview people anymore. You don't have the college recruiting thing set up to pull people into your company. And that just means you're going to get worse and worse quality candidates, and the productivity goes down. And we just saw that in the last productivity report, which was, I forget the number, but it was down considerably. Was that last week? Where was that? May 11th to 15th. That's this week. Damn it, I can't go backwards. Oh, that's so annoying. Archive. Wait a minute, archive. Hang on. Pick a date. Last week. Oh, it's being Damn it. Being literal. Trade balance, factory, or seriously? Oh, productivity. There you go. Minus 1.9%. Can you believe I found it? That's fantastic. Minus 1.9%. So productivity fell off 2% last month. And that's good, though. That's good for the human. That's good for people. That means that they need people. See, when productivity falls off, that's not a bad thing. That just means that you can't squeeze more productivity out of the people you have, and therefore you have to then hire more people. If you want to increase your business, you can't get it anymore from productivity increases. You have to now hire people and pay people to do the job. And that's a big change. They're sort of just starting right now. Chrissy says, you said prior to being bullish that Japan was on the verge of bankruptcy because of their debt. So doesn't Japan's fragile economy affect the markets? Yes, it does. No, look, these are called crosswinds. I mean, yeah, I'm very worried about Japan collapsing. If Japan collapses, the market's going to go to shit. That's why I still want to be mainly in cash. But long term, and by the way, I don't think Japan will collapse. I think Japan could collapse, but they won't collapse because what's going to happen is everybody in the world is letting Japan collapse would be catastrophic. So I think what's going to happen is that they're going to all the countries are just going to have to agree to let inflation just start running along. And if there's a lot of inflation, like if Japan has inflation, with inflation what you do is because your debt is fixed, right? We have $18 trillion worth of debt in America. That debt is mostly in longer term notes, 30-year notes, 10-year notes, 5-year notes, right? $18 trillion. If we let inflation run, there were two things you have to do. First of all, you have to stop going more into debt. That's very important. But if we can kind of stop borrowing more money and increase our GDP through inflation, like 10% inflation each year. Right now, our GDP is $18 trillion. If you add 10% inflation every year, let's just call that $2 trillion a year average over 5 years. What happens is in 5 years from now, assuming we don't borrow a lot more money, 5 years from now, we have a $28 trillion economy, and we still have $18 trillion in debt. That's much better, isn't it? Instead of an $18 trillion economy with $18 trillion in debt, if we can run inflation at 10% for 5 years, we'll have a $28 trillion economy, and hopefully with the same $18 trillion in debt. See, that's clever. That's how you get out of it. We did this, by the way, it's what we did in the 70s. All the countries on Earth in the 70s had what essentially is hyperinflation. And I know you say hyperinflation, everybody thinks Zimbabwe or something like that, where they have, a 1 billion percent inflation in a year. But hyperinflation is technically anything double digits that's sustained for a couple of years is called hyperinflation. And we sure had that in the 70s. I mean, I don't know if you guys are old enough, but we had, at the peak, interest rates were 18%. They actually expected you to buy a house and pay 18% interest on the house. That's crazy, right? But that's what it was. Now, of course, a house at the time was $60,000. So 18% interest was $12,000. That's still a lot of money because you'd be lucky if you had a job that paid $25,000 in the 1970s. But still, you could see where it's doable. It's something where somebody say, "Oh, I guess that's what a house costs." You're paying still little for the actual house. The interest is in perspective. Still, that's what killed it, though. Of course, I mean, obviously, that's what ground the housing boom to a halt. But meanwhile, house prices were going up 10, 20% a year. And I know my parents in 1970, how old was I? I was 13, so it had to be 76. In 1976, my parents bought a house for about $60-something thousand bucks, $65,000 bucks, I would guess. When I went to college, 8 years later, when I went to college, maybe 2 years after that, they sold the house. So 10 years later, they sold that house for $350,000, something like that. So it's like 5 times what they paid for it in 10 years. That's how fast prices were going up at the time for houses. Now, that's good though, because what does it do? It also it pays. Here's what it does. It takes that whole generation that would have been screwed money-wise because of the recession in the 70s, and it gives them, since most people do own homes in the U.S. anyway, most people do own homes. It gave them an entire, it helped them pay off their mortgage because the $60,000 mortgage was insignificant to the price of the house down the road, And that gave them a big fat amount of money. $250,000 at the time was a lot of money, and it gave them a ton of money in the bank to retire on. And Jim says it created mansions. Sure. Then it causes other problems. It caused the whole. In fact, that caused a stupid housing boom in Florida. You know, because all these people, all my parents, well, especially in my area, everybody in the Northeast took all the money they made selling their houses, and they all moved down to Florida, and they bought cheap houses and had a ton of cash. And then your parents would sit there and tell you what financial geniuses they were because they invested in real estate and blah, blah, blah. That's what created the entire investing in real estate myth. Because that's what all your parents and all your parents' friends would tell you. It's like, oh, real estate's the best investment in the world. If you have money, put it in real estate. In fact, I wish I bought 10 houses when I was younger, blah, blah, blah. That's all bullshit. It all was just because they happened to catch a certain economic wave that worked out for them. There's no long-term reason to keep investing in real estate. They just caught it at the right time when they were young. You know, when they were coming out, when they were first having kids and getting their first home or their second home, they just happened to luck out and catch it at exactly the right time. But then that causes a myth that persists for like 20 years later, right? Even now, it's only our generation, or I'm 50, so it's only my generation that finally realizes and tells my kids housing is not necessarily such a great investment. And that's all because we all got smacked in the face a few years ago. Not because we're geniuses, just because everybody said, wow, this stuff can crash too. But it was so shocking to people in 2007 that the housing market could crash that even while it was crashing, nobody believed it. They're like, something will fix this because housing, it's real estate. Real estate always goes up. That's not true. It's a myth that was created by our parents' generation because they lived through it. They thought that's how it worked. Their parents lived through the Depression and saw a housing crisis collapse. Their parents and grandparents went through the Depression. So my grandfather was never a fan of real estate. He was born in 1903. He never thought real estate was a great thing because he'd seen people lose their entire lives on real estate in the Depression. But then my parents think they're smarter than their parents because my grandfather wasn't a big real estate guy. My father goes and buys real estate, and he goes, hey, this stuff's fantastic. Then he tells me as his kid, oh, real estate is the best thing in the world. That's how it works. That's how misinformation spreads from generation to generation because everybody thinks whatever cycle they were in is the only way things go. That's what causes this stuff. All right, anyway, so that's where the long-term bullish call comes from. You know, you're looking crazy. That's what this whole story was about. You're caught up in cycles, and I'm looking at a bit of a longer-term picture. So I'm looking ahead of the game to what's actually going to happen over the course of time. I don't see Japan defaulting because it would be a complete mess, but Japan inflating its way out of trouble with the rest of the world, that's what I see happening. And believe me, these central banks are not printing trillions and trillions and trillions of dollars to not cause inflation. That is not why they're doing it. And these dollars are out there. How do you think they're going to get them back? This is another funny thing. They print all this money. It's going to eventually start causing inflation. How do you think they're going to get it back? It doesn't work that way. It's very hard to put the genie back in the bottle once it starts going. So we're going to see some serious crap going on in the near future. All right. Pat says lumber liquidators below 27. That's exciting. I mean, that's fine to me. It's 27 is basically our buy point. Oh, it's barely below. Come on. So we had a nice run. It went up to 29 on Thursday, came back down to 27, goes back up to 28. Today there's a negative news story, and it's back to 27. Still a buy, people. Here you go. It's 24 on Thursday. Where was everybody? Actually, it was 7 in the morning. They are trying as hard as they possibly can to get every single bullish person out of this stock. And look, if you stare at it every day, to me, it's a buy and forget kind of stock. I mean, I've got no interest in following it. I don't care what happens day to day. I'm not going to get out of it. If it goes much lower, I'll buy some more. It's stupid. In fact, we were talking about that this morning also. Where were we on lumber liquidators? I know we talked about that in the morning. In fact, we talked about this last week's seminar. I remember discussing it, but here's the chart to back me up. Oh, hey, no, not that one. Here you go. I think I said this last week, right? GM, here's GM. Somewhere around here, we have the story probably around here, we had the story that they killed people. People died because they had faulty ignition switches or whatever the hell it was, and I think the number was 13 at the time. 13 people died directly as a result of their ignition switches, and they knew it. They knew it. They covered it up. They kept selling the cars with the faulty ignition switches because the recall would have cost them $100 per car, and it wasn't worth it compared to the cost of a couple of lawsuits. Now it's 100 people. That's the article today. This is a Today article. Now it's 100 people. Actually, it was over the weekend that I started seeing this statistic. 100 people are dead because these sons of bitches didn't do a recall. And here's their stock. Okay? Lumber liquidators sold a floorboard with a little bit too much formaldehyde in it. Nobody died. And it's not even for sure that they did sell this floorboard. The rumor is that the floorboards have too much formaldehyde. Now, nobody died. Nobody ate the floorboard and died from the formaldehyde. No babies licked the floorboard and died from the formaldehyde. Nobody was injured. Nobody's life was ruined. Nobody's house is unlivable because they have formaldehyde in the wood in their floorboard. Because, by the way, the only way you find the formaldehyde is you have to take the floorboard and grind it up and study it under like an oscilloscope and find out like what's inside it. And it's only illegal, and as Jim says, it's only illegal in California. Everywhere else in the country, it's way below the legal limit for formaldehyde, because don't be silly, there's things like that in everything. It's like there's a certain acceptable amount of insect legs in peanut butter, right? It's like everything has a certain acceptable amount of animal parts and insect parts and whatever. Everything you eat, drink, chew, whatever, it's all got acceptable levels of horrible things. So the difference is here's GM, and here's GM, and here's Lumber Liquidators. This is just stupid. This is a completely ridiculous reaction to a story that is not a big deal. There's not even an accusation that they covered it up or did anything wrong. GM did. It's a fact. So Lumber Liquidators still sell the 30. Yes, it's still the same play. I mean, it's a little riskier. You can go lower because of the dip. If you want to be more conservative with Lumber Liquidators, I mean, look at this. You can sell. Jesus, really? Look at these prices. You can sell the $18 puts for $320. The 2017 $18 puts, it's at $26 now. So think about that. You're going to sell these things for $320. You can probably get $350, frankly, if it's $320/4. You sell these puts for $18, collect $350, especially if it's heading down now. And then you take that $350 and you buy the 20s for $10.75. And you sell the 30s for $6.75. That's net 4, right? So your net on this trade, the 20-30 bull call spread. So what were you asking about, the 30-40? No, I would not do that now. I would sell the 18s for $3, for $3.50. I would buy that spread for $4. The 20-30 bull call spread is $4. And your net there is 50 cents. Your net is 50 cents on a 20-30 spread when the stock is at 26. That's fantastic. You're $6 in the money. You're spending 50 cents cash, and your worst case scenario is you own the thing at $18.50 net, which is $10 off the current price, so about 30-something% off the current price. That's a gift. It really is. In fact, that's such a gift. We should do it in the long term. We should add some in the long-term portfolios. That's getting crazy. I mean, it's not. It doesn't fundamentally affect their business. They sell lumber. They can't sell that lumber anymore. Don't sell lumber with formaldehyde in it anymore. Okay, sorry. What would be the damage to the people who have the formaldehyde lumber? If nobody's dead, and I've heard nothing to the point that anyone's dead or harmed or injured or anything like that, nobody's dead. I guarantee they will find somebody who got cancer or something, and they'll blame it on that. So nobody's dead, and they've got no harm, no damages, whatever. All they have to do is, don't forget, they sell 100 types of lumber in their store, and this is one of the types. So even if you assume this is 20% of all the lumber they sell, what they have to do is go back to the house, take up the floorboards they have there now, and put down floorboards that don't have formaldehyde in it. And that's it. And they say, sorry, this is what they do every day. This is their job. This is what they professionally do. They go to houses and they take up whatever carpet or floorboards are there now, and they put down nice new floorboards. That's their job. They know how to do it. They've got the people. They've got the staff. They've got the equipment. This is not a big deal. This is all that's going to happen to them. They're going to lose traction for a year. They're going to have, they'll probably lose money. These lawsuits, so I don't understand what somebody is even suing about. All you can do is make them fix it. Chrissy says, does it matter which order you put the trade in? Do you do the spread first and then the naked put? No, it doesn't matter. I mean, look, 350. Somebody filled. Good job, whoever just did that. See, somebody asked for 350 and they filled for 350 instead of it. Never take the bid they offer you. Look at the bid-ask spread and pick something reasonable in the middle. So whoever did that, that's good job. So from obviously we're having that discussion. Somebody just filled at 350, so they're done. All right. So yeah, that person got it. And think about it, when whoever that is sold for 350, their net now is $14.50 by that. So if you sell the put first, obviously, oh, okay, good job. So you see, all you have to do is ask, and you get a better price. That's a really important thing to learn. Don't be a sucker and go by what they tell you. It's like you can do better. It's an auction process. You can make a bid. Oh, look, now the ask has dropped to 350. See how funny that is? We're affecting this right now. We're causing this stuff. So because you paid 350, somebody dropped their asking price to 350. They'd like to sell now, so now we can buy more at 350 very easily. All right, so you fill that first. Oh, and by the way, you see this? Maybe you can do better than 375, but the point being, for 25 cents, would I sell the 20s? No. Why would I, right? Now, you might do better up here. It's a 4.7 is a very wide spread, so it's not really fun to bid on. 350, there was so much money for the 18s because you're netting $14.50. So, Chrissy, if you fill that first, what's the worst thing that can happen to you? You own LL for $14.50. That's fine. Then you fill your spread. And again, with the spread, it's the same thing, though. It's like if you're going to buy the 20s, and, oh, somebody did it for 1075, so that's exactly where we want it to be. So 1075, and then you do the other one. I bet he did this one, too. Let's see, the 30s, 636. So he actually got a better price. No, actually, I'm sorry, that isn't a better price. So you want to get 1075 for these guys, and you want to get 675 for the 30s. And that's it, you offer. And what I'll do, and again, you got to learn it's not a big deal, Chrissy. If you wanted to do 10, why don't you do 5 and just offer a good price on each leg and see what fills? That's how you get in. Whichever ones fill are fine, then you can work on the other one and see how you do. And if it doesn't fill well, you try to fill the other ones. But you have to understand there's a dynamic here, because if the price, since you're betting against yourself, right? You're buying one and selling another. Since you're betting against yourself, if one gets away from you, it means the other one got cheaper. So you always have an opportunity to scale in and do better. It's like you don't have to put your whole order in at one time. You can just buy the thing in bits and pieces. So yeah, usually, obviously I don't do these trades in stocks that I don't actually want to own. So generally I'm going to want to, sell the puts pretty much immediately, because I got no problem with selling the puts. And the call spreads, though, they often take longer to fill. So I just try to get my prices. And so I will generally offer I will try to offer usually 50 cents better. You know, well, not 50 cents. Let's call it 5% to 10%. So I will offer 5 to 10% better than it looks. Like I'll try to offer as close to the. If I'm buying, I'm going to offer as close to 1050 as I think I can get a fill for. If I'm selling the 30s, I have you don't have much to work with here. You have 650, 680. So I would really want to offer as close to 680 as I think I can reasonably get. All right. Now, one of them is going to fill. I can offer, you know, in other words, I offer close to the top here to sell, and I offer close to the bottom here to buy. And you know what? As lumber liquidated goes up and down, or any stock it goes up and down, one of them is going to fill. I don't know which one, but one of them is going to fill, and that means I got a good price for one of them. But then I have to say, well, I hope that I can fill the other one. Then I've got to do something about filling the other part. But at least one of them is going to fill. Now, especially if you're doing the spread first and you don't do the puts first, if you get a fill here at a good price, if you get a fill on the short calls at a good price, and then it gets away from the other side, you can sell the puts after and you know you're going to get a good price. So you know everything goes up and down and changes. If you've got 3 different bets in 2 different directions, you've got a very good chance. You can't not fill well. You can't not get a good fill on all 3 legs. That would be pathetic bidding. You've got to get a good price on one of them at least every time you do this. Otherwise, shame on you, because how could you not? And if you're patient, even if it takes days sometimes, you're usually going to get what you want. But that's the other thing, is I like to have that anchor where I know for sure I sold the put. So even if I sell the put and I only get the short sale on the call, at least I got the short put and the short call, and they balance each other out somewhat. All right, so that's how you want to look at that. Oh, speaking of trades, so later in the day, this was this afternoon in member chat, right before we started the seminar, U.S. Steel, right. It doesn't come out of the blue. I've been thinking about U.S. Steel for a while because it is pretty cheap. And I hadn't made a play on it, mostly because it's a material stock and we've already got a lot of materials in the long-term portfolio. But today, Morgan Stanley came out with a note strongly suggesting buying U.S. Steel. Well, whatever, you know, look, the expectations are low. That's exactly right. That's why I was liking them. Their price of steel is coming back a little bit. And again, the economy is slowly but surely waking up a little bit all around the world. You see a little bit of improvement here and there. And that's all U.S. Steel needs. They don't need a lot of improvement. They just need a little bit of improvement. They were priced like they were going out of business. This was a $100 stock a couple of years ago. Now it's 25 bucks. So it wasn't good for the long-term portfolio, but here's a great play on U.S. Steel. I decided to do a 1-to-2 spread. We're selling 5 of the 2017-20 puts, and again, not in the portfolio, but this is just the example of how you can do it. You sell 5 of the 2017 $20 puts for $3. That's going to give you 1,500 bucks in your pocket. And what are you doing? Same thing we were just talking about lumber liquidators. I'm agreeing to buy U.S. Steel for 20 bucks. So I'm going to consider this $3 to be free money, right? So for 20 bucks, for 20 bucks, I'm going to buy 500 shares of U.S. Steel. All right, that's $6 below the current price. That's a 20% discount at least off U.S. Steel. I'm going to buy 10, not 5. I'm going to buy twice as many of the 2017 25-30 bull call spreads. Here's 25. Here's 30. Here's U.S. Steel where it's been recently at 35 to 40. Here's where it was way up here off the charts is where it usually is, you know, over longer term periods of time. Oh, wait, let's see. Not that one. Where is the stupid thing? This one. Well, they had an example because they're actually lower. But anyway, so over the long term, this it's a $25, $30 stock generally. And going back more years. See, now I got to go to pull the bigger chart. In better economic times, they perform much better. Oh, it's been that long. Holy cow. Well, okay, so they haven't been $100 since 2008, so I apologize. It's a little lower than I thought. But they're $50 over here up to 2011. Then things started slowing down in China, and U.S. steel started suffering because the whole world had a glut of steel for a while. But they are making money. They still managed to muddle through. They're doing okay. Not great, but okay. And also there's this whole new TPP thing and all this other stuff that they can get some more favorable tariff stuff going back and forth in trade deals. That's what Obama is pushing for. Whether it's good or not, I think TPP is probably a disaster, the same way that NAFTA was a disaster, but you know, it's certainly going to help some people, and U.S. Steel should do a little bit of benefit. Where were we? Oh, yeah. So I like the 25-30 bull call spread, so it doesn't take much of a recovery, and they're going to be right back in business, and you're fully in the money. And you're buying the spread for 226, so that works out to $2,260, less than $1,500, $760 of cash on a $5,000 on 10 $5 spreads is $5,000. So this thing can profit 4,000 whatever. Wait a minute. 92? That's wrong. Shit. This number should be 4240, not 9240. So you can make $4,240 on this spread, which is not 1,200%. It's like 600 and something percent, I guess. Yeah, I'd say the problem doing math in my head. And so these spreads are you paying net 760 and you can get back 5,000. That's the bottom line, which is a 4,240 profit. All right, that's a really, really, really good use of your money. So I like this too. I love trades like this. I love things where your worst case is getting a good discount. How do you cancel an order on TOS if you put it through incorrectly? You just right-click on it. So whatever you ordered, you'll have an order window, which I don't have, obviously, because I don't have anything on order. What you do is right-click on it, and it says cancel. Oh, and you should be able to find it. No, trade, futures, active. It should be down at the bottom here. Or you find it if you go to the actual position you ordered. You should be able to adjust it by right-clicking on the position. And see, like here, I can make an order, so I guess I can cancel it too. Where are we? Charts. Let's see. And everything is sort of flatlining. So today nothing has. So once again, we have a day where nothing actually happened. It's very interesting. And it kind of makes you wonder what they're trying to accomplish. You have to think about that. Like, what are they really trying to accomplish by moving stuff around like this? Because what's the net effect? Let's get back to that Yahoo thing. So if we go to, nope, log linear, candles. There we go. And if we look at the S&P, geez, look at that. That's a 10-year view. But look at that. Since March of 2009, 750 to 2100. That's 1400. That's basically 200% higher. Oh, the monitor tab. Thanks, Jim. Thanks, Jim, and thanks somebody else. Oh, that's Jim twice. Yeah. All right. But in the 1-year view, or the year-to-date view, let's say, what the hell is going on? So actually, you do have to keep going back to figure it out. So we've got to move up from 2,000 to 2,100, which is nothing. It's 5%, right? That's a 5% move. From 2,000. Now, see, 2,000 was a good, all along here, 2,000 seems like a real serious line of contention. We've moved up 5% since then. And the question is, do we have the ability to go up 10% from here? And we'll go back now, 2-year view. Serious consolidation. We break over 2,000. Big. I mean, this is a year of consolidation. From here to here is a year of consolidation along this line. Some below, some above. Now we've moved up 5%. But you know what? It's not that impressive, but it's not that different either than what happened here. Here's a year of consolidation. Here's a 5% move up. There was a big sell-off, then there was an even bigger sell-off, which is what we're waiting for, and then it took off again. We're kind of waiting for that. We're waiting for one of these big sell-offs where we really test that 2,000 line one more time. That would make me very happy. And here's a 5-year chart. And you can see it's not, it really, you know, it's clearly losing momentum. You know, here, you know, in this period here for the year 2014, we went up 1 box, right? In 2013, we went up 1 box. In 2012, we went up 1 box. And not really before that. So here, these two guys together are, these 2 years together make up half a box. So there's a 1 box here, but then it faded. All right, so what's 1 box? 1 box is, in this case, 250 points. And here, we're struggling to get up half a box in a year. So the momentum is fading. All right, we're running out of gas. That's what that indicates. You know, when you know, it's like a ball bouncing. It runs out of energy, and you can see like each bounce and each successive bounce is less and less and less. And that's kind of what's happening now. We're running out of energy in the market. The volume clearly isn't there, and so we've got to wonder what's going to happen. In fact, if we take a year to date, is that going to show us? No, it's not really going to show us. 1 year, 2 years. Yeah, you can't really see it. The volume's kind of like down here, and you can't really tell. I mean, it was up here last year, so we're down considerably, but not, you know, I'm probably about 20% less. But the thing is, let's see if we can have a gauge that goes back further. I just want to see if I can find the last time we actually had volume. Oh, no. Nah. All right, so as you can see here, though, in 2008, when we were crashing, but even here, we had a lot of volume. All the way to 2010, we were always above this line in volume, right? Now, we haven't been above that line since 2011. We haven't been above it. And we're actually at the point now where we're running like probably about 20-25% below that line in volume. So we're down we're down 25, I'd say almost 50, we're down almost 50% from the highs in the volume. It makes it a lot harder to take anything seriously that's going on, though. You can't tell when you have low volume what's going on. Jim says, on LL, I currently have long 25 calls currently uncovered. Well, that's terrible. All you're doing is selling premium. You know, you're paying premium to somebody for a wish. That's not good. You know, look, if you're in Lumber Liquidators, they're at 26. You have the 25 calls. For what? Oh, Jesus, they're so expensive. Why would you do this? They're $850, let's say. All right, or $860, doesn't matter. But they're $850 at 25. It's only at $26.50, so that means $7 of that money that you have is premium. Okay, that money for a fact will disappear. Even, you have to understand, even if Lumber Liquidators goes to 35, and you get $10 back on your 25 calls, right? You still lost all your premium because you didn't get the gain, did you? You know, you're sitting with 25 calls, you've given the whole game away. Because if it goes to 35, and I mean into 2017, but if it goes to 35 and you're sitting on those things in 2017 and 35 and you get $10 back, what the hell did you do? What kind of use of your money was that? And so what I'm saying is, instead of tying up $850 for nothing, then you do the spread I was talking about, because the spread, you're going to collect your 350 here. You're going to, that's for the 18 puts. You're going to buy the 20-30 bull call spread for, what did we say it was, $4? So then you've got net 50 cents in cash. You're taking $8 off the table. And the worst thing that can happen is you get a signed lumber liquidated for 18, which is going to use $9 worth of margin. If even if you're paying full margin, that'll cost you $9 in margin, right? To have an $18 stock. But you've got the cash back in your pocket to pay for it. So why would you be sitting here letting the premium go on that stock? All it's going to do is just keep eroding and eroding and eroding. It will, no matter what the stock does, it's losing value. The premium in your position is losing value. It doesn't matter if the stock goes up or down or sideways. The $7 of premium that's in that position will disappear. You're paying it no matter what. The fact that you might accidentally make money if it goes higher, that's the thing. You can't get filled. That's weird. I don't know why you can't get filled, Chrissy, because frankly, it's right there. That's the ask. Don't worry about it. Just what are you going to do? Leave your bid open. I mean, so that's your offer. And see if it gets filled. That's all. All right. So getting back to Jim. So Jim, yeah. I mean, don't do that. Don't be the guy who buys the premium. I don't know if you have portfolio margin or not, but you must have a lot of money if you're tying up at $850. You're tying up at least $1,000 in that position. And it's not even, it's barely in the money. And you realize, of course, if you do my trade, right, you sell this for $350, you're in net 50 cents. It only has to go to 30, and you make $9.50. So this thing makes more money at 30 than you would make at 35. Now forget 35. You have to go to 40 something to make $9.50, almost 45. You have to get to. And this position makes that at 30. So where's the logic to being in the long haul? And this is what I'm trying to teach you guys, is never to do stuff like that. So you're in it from a roll, and you're buying back the short calls to the profit, and you're waiting for the profit. Okay, that's all fine. I mean, I understand it's fine how you got there, but the point is you don't want to be there. Just because you ended up in it, you still have to look at that and say, oh, that's something I never want to do. I never want to be sitting there with a naked call that has 90%, 75%, 80%, whatever the hell it is, has 80% of my cost of 80% of the price of my position is premium. That's never a good thing. You have to immediately want to change that whenever you see something like that. Now, the only reason you might want to do something like that is if you're taking a huge gamble. Like if I didn't believe in lumber liquidated holdings value, and I said, oh look, I wouldn't do it because it's too ridiculous. But if I said, oh, you know what, we could take a stab at like the $35 calls for $5, I wouldn't do that because $5 is ridiculous. But if I was so inclined and I would sell a premium, you're doing that just to limit your losses. Why is that ringing? That is so weird. That's 2 weeks in a row. The same line that never rings, hasn't rang since last week, is now ringing again. That is the weirdest thing. The last time that rang was last week when we were doing the conference. All right, Jim says, usually not a premium buyer. See my second comment. Yeah, I see it. Okay, so anyway, the point being, though, it should bother you. The second you're in a position like that, it's got to bother you. You got to say, I hate this. I don't want to be in it. And then you just take a step to get out of it and change it. But that's easy to fix because all you have to do really is do the sale. You're in the 25, so you can do the same thing though. If you buy the 30s. I'm sorry, you don't buy the 30s. You sell the 30s. Use that money to roll down to the 20s. And then optionally, which I would, you sell those puts, and that basically puts you in the position we were just talking about. All right, so nothing else very exciting going on, and we are fizzing. I'm sorry, we were looking at that. But why? That's my question. Why is this happening? And I don't think it's happening. I think what's going on, if you look at these bars, red, red volume, lower volume green, higher volume red, lower volume green, much lower volume green. Well, what is that? That's the current. No, it's not even the current period. Look at that. May, this is a monthly, I guess. The month of May was so much lower. It's way, I don't know how well you guys can see that. It's way down here. That's ridiculously low volume. All right, and that's really scary. When the volume gets that low, that gets really, really scary. All right, well, we're halfway through the month, but I mean, that's way down. It's like much, much lower than you'd want it to be, considering it's what, the 12th today? That is not healthy. Let's take a look at it closer and see if we see the same thing. It doesn't look so terrible close up. It's bad, but it's just, where's May 1st? Here's May 1st. So low, low, high, a little higher, really low, and today is not, well, this today? Today's probably not registered correctly. That's probably why it's showing so badly. But I think we're just toppy. I think that there's not much of an answer to it other than the fact that we're toppy. People are exhausted. You can't find any more buyers at these prices, and you can't find, and the sellers are having trouble getting out. And it's very, very likely we're going to have a correction. But this isn't a big correction. I think we're going to check out the 2,000 line. Hopefully that'll hold. If it doesn't hold, we could have a big pullback all the way to 1850. 1850 is a must-hold line. Here it is, right about here. So 1850, if I can find a good example of it. Around there. Okay, 1850 is the must-hold line on our big chart, and so that's got to hold. That really has to hold. I don't see why it would break, though. I don't think the economic conditions are so bad, other than Japan exploding or China. China could melt down too. I don't think there's going to be much of a cause for us to go below that line. So, providing they muddle through, we shouldn't have more of a pullback than this. So that's going to be a 10% pullback at worst. I think more likely, though, we're just going to have this little mild pullback to 2,000, and then hopefully that'll consolidate there a little bit, and then we can talk about having more of a rally. But for now, I still want to be cautious, because again, this Japan thing really does bother me a lot, and I'd like to see some sort of resolution to it, and I don't think we're going to see that. I think they really want to fake their way through the summer right now. So we're going to have to be patient and watch how the market develops. Still, though, I mean, I was looking back at the trades. I mean, we had a dozen different trades that we found last week, and the week before we had a whole bunch. So it's not like we're not finding stuff to buy, like long-term positions and so on and so forth. It's just that we're being very, very cautious about entering them. We're not putting them in the portfolio so much. But on the other hand, you know, if we look at the long-term portfolio, let's see where we are. Here it is. So the long-term portfolio is up 52%. So, I mean, honestly, it's not like, it's not really worth worrying about, is it? It's up 52%, which is way ahead of where our target is. We're only trying to be up 40% by the end of the year. So our goal on the long-term portfolio is not to lose 12% by the end of the year. I'm obviously not going to do that, but, oh, I'm sorry. Molly says, what is your recommendation on LL? Sorry, we did that. You're late. You're obviously late. We spent a huge amount of time discussing it, but it's the short 18 puts in 2017 paired with the 20-30 bull call spread for net of 50 cents. That's what it is. Selling for $3.50 the puts, buying the spread for $4. That's our pick. So where was I? Oh, yeah. So in the long-term portfolio, if we look at things that we bought in April and May, we've got 1, 2, 3, 4, 5. I'm not even counting 327. 6, 7, 8, 9, 10, 11. So 11 positions that we've added in April and May to the long-term portfolio. We can't add 11 positions a month. We'd have 120 positions. So since we cashed out in March, oh, I'm sorry, I should add the 327. So it's really 12 because we cashed out on March 24th and this one was added since. So since we cashed out, though, we've added a dozen positions back to the long-term portfolio. that's a pretty good clip. I don't think we can do a better clip than that, so we're not going to try. We don't want to overtrade, and those are just the ones that were officially added. Like I said, there were a dozen positions that we didn't add, but were also good long-term positions and trade ideas, like the U.S. steel trade that we just looked at, like the lumber liquidator trade that we just looked at, because we already have an LL position in the long-term portfolio. And we're going to actually adjust this to make it a better one, but we'll see. We'll work on that later. So it's not like there's a lack of things to trade. It's just that this market is crazy and we're being very cautious in our approach. But there's so many bargains around that we're adding, even being as cautious as we are, we're finding 12 things a month to trade. That's a lot. Or 12 things in 6 weeks, which is what? Now we're averaging 2 things a week that we're officially adding to our portfolio because they're so good we don't want to lose them. So there's no dearth of opportunity in the market. There's plenty of things to trade. And there's also no pressure, though. Okay, I don't want people to feel like there's some kind of huge pressure to buy things. Just because you have cash doesn't mean you need to spend it. Something will always come along. Every week something comes along. Every week there's great trades for whatever reason. In this case, lumber lumber liquidators. Like there's a tragedy. Something happens. There's a problem with the business. It falls down. We had a re-entry recently on Taser before it took off. Which we know we love Taser. It fell down. iRobot got cheap when we picked it up again. Who else are we jumping on? Mylan is getting bought, and so we did that trade. We have here's Taser. We added them on 428. We added Taser, and now they're back up at $33, which is almost at the top of our trade. We took a 25-35 spread on 428. It's already at 33. We're almost 100% in the money on that one. All right, it's UCO is the oil. We went back on the long oil trade here. No, I'm sorry, we're short on that. I apologize. We're short on that one, which is actually working. Look how nicely that's working out for us. We're up $4,000 on that piece. All right, and then the stuff that hasn't taken off yet, like CLF. Well, actually, I take that back. CLF is actually moving now, but still playable. DBA, we're still waiting for some traction on DBA. So there's plenty of stuff. Oh, Joe, we just picked up this Joe trade for coffee. There's certainly no shortage of things to buy. Just worry about, watch the trends and watch the market, but nothing's getting away from us now. There's tons of opportunity here. Whether the market goes up or down, we're fine. If it goes up, then we've got plenty of bargains we can still pick up, and if the market goes down, there'll be new bargains that we haven't been able to play before. All right, so I'm very, very happy with where things are, and let's take a look. The long-term portfolio, as we just said, was up 52%, right? And if we look at the short-term portfolio, which is supposed to protect the long-term portfolio, that's up 116%. That's crazy, right? So that's not even supposed to be making money. That's supposed to be down when the long-term portfolio is up. It's supposed to be a balance. We just have been fortunate in the calls that we've made, and we did some good ones. Like last week, we doubled down on these SDSs last week because it went down to 75 cents. That brought our average down from 105 to 90. And today, here's the funny thing. Today, we sold half of them back at 105. But because we sold, we started at 105. We started at 105 with 50. We then bought another 50 at 75. So when it went down to 75, which is about 20% below the original price, instead of panicking out of it, we bought more because we believed in the trade. That made us an average of 90 cents on 100 contracts. Today, because of the nice dip we had in the morning, it went back to 105, which is where we bought it. But because we dropped our basis to 90, we actually made 15 cents a contract on 50. So that's what, $750. So now our net average on the trade is not 90. It says 90, but it's not really 90 because we bought, remember, we bought originally at 105. We sold at, we bought more at 75 and averaged 90. Then we sold half at 105, which is a 15% profit on 50. So our actual net on this trade is 75 cents now. So we have the same 50 we wanted to get when we started the trade at 105. Now we have it at 75, which is the lowest price we've seen so far on the spread. That's the intelligent way to hedge. There's no greed there, okay? The minute we doubled down, we were looking for a chance to get out. And this morning, and thanks, I think it was Jim who reminded me, thanks for reminding me, because that's exactly what we're supposed to do. As soon as you get a chance to get out even, you get out even path, and what you've accomplished is you've lowered your basis. Because that's all you're looking to do when you double down. You're looking to lower your basis. You're not looking to double your exposure. What you're doing is you're putting your foot down and saying, I think this is a temporary move against us, and I think that it's going to go back to the norm. And by going back to the norm, I'll be able to get out and lower my basis. And that's how come we're up 116% this year on a hedging portfolio, because we make smart moves like that, because we have the conviction to stick with our trades. And I'm not saying you always should have conviction, but we've taken some pretty good losses with our conviction, I'll tell you that much. All right, some of you, we've got some pretty large losses, but we've also had some really great hits also. All right, so I'm not going to go over these now. I'll probably go over them tomorrow or Thursday. But here's some lumber liquidities too. So we sold these puts. It's just a matter of taking the opportunities and also not panicking, though. This is the real key that I'm trying to say is things go up and they go down. And when they go up, when they're in our favor, well, we bet up and down in this portfolio. When they're in our favor, we take the money. When they're not in our favor, we adjust the position. Now, again, though, I'm saying assuming that we still believe in it, okay? Always you have to re-examine. And you never put a dime into a trade if you don't absolutely believe that that's a good trade at the time. You don't put a dime in just because you're losing. You put a dime in because you're losing and you think you're losing for the wrong reasons. That's when you add some more. But by doing that, by constantly adjusting our positions to improve them when we have a chance, and by, obviously we've made some good calls because we're generally right, sometimes our timing is just wrong. But when we stick with our losers and adjust them and improve them, and then we take our winners off the table, it's a funny thing because it just starts accumulating. The money accumulates, the profits accumulate into the portfolio. And that's how this works. All right, and we're doing it very consistently, and I just need you guys to just watch and pay attention to it. Not, the idea is to show you how this stuff works over a long period of time. So we're sticking with these. Usually we would have closed the portfolios and started new ones by now, but I'm trying to show like over the years. So we're going to give it like 2 or 3 years. I want to show over time how much you accumulate when you do this, because it never looks that impressive when we just cash them out and everybody's like, oh, they forget all about it already. Now I want to just hammer home this concept. So I'm going to keep talking about it over and over again. I'm going to talk about the concept of planting those trees, putting your positions in, balancing your portfolio, not taking big chances, not selling premium, never buying premium, sell premium, sell premium, sell premium. Because you know what? You always win. Even when you lose, you win because you still collect the premium. You always have that consolation. That's the trick to this kind of trading. No matter what happens, we get the premium. All right. Al-Sadir says, I have Twitter bull call spread, January 16, 40.55. It was good until earnings. Now it's not. Is it a good time to sell the 2017 puts? Which ones? Oh, what's Twitter doing right now? I like them. I don't love them, but I like them. I think we actually put them in the long-term portfolio, didn't we? Oh, that's so horrible. Look at that. Yeah, I think this is a good price to be in it. You have the 40.55. Okay, so first of all, that's not good because it's ridiculous. You shouldn't expect it to go all the way back. What did you spend for the 40.55 spread? That's question number one. So I know we had Twitter somewhere. Oh, there it is. Actually, we did bet they would rebound. We bet up to January, this year, January, the 38.45. So we're not in much better shape than you are. We got the 38.45 spread, but we only paid, what is that, $2.10 for it. So we're actually ahead by a little bit right now. So we paid $2.10 for that spread. That doesn't mean I recommend it. It's just the one we have. Do we have it in the long-term portfolio too? No, we don't. We only have them in the short term. I think we probably sold some puts, so there you are. We just sold some 33 puts. So there's my target. My target's 33 bucks in 2017. It's not a very aggressive target. And actually, it's losing right now, so I still like that trade. If you sell these 10 January 33 puts for 580, that's a pretty good net. All right, so now let's take a look at Twitter. About the last one I got to do, then I got to go, guys. So I got Twitter here. So you have the 40.55 January. Oh, this January. Okay. So here's what I would do. I would take the 40s. You're going to get 435 for them, basically. 432 is the last. So you're going to get 435 for those. And I'm going to invest in the, I guess the 35. So I would invest in the 35s, which are coming in at like 990 according to this. So figure 975. And what we say, 445. So about 330 to do this roll. So you're going to go to the 30. You're going to go to the 35s. And it's going to cost about 330. Then you could sell. Now you want to all you want to do is just get your 330 back, right? So you sell the 28 puts in January, and those things are 330. That pays for your roll. So you buy a year of time, and you buy $5 worth of position, and all you're doing in exchange for that, you're not paying any cash, but you're promising to buy Twitter at 28. Now, Twitter's at 37 right now. If you don't want to actually own Twitter for 28, why are you even in this trade? All right, so if so either you're willing to promise to buy Twitter for 28, or you should be closing the trade out. That's basically the way that works. If you do it though, that's your trade. Now, is it then worth it? What are the 55 put calls at? The 55 calls are at $1. Okay, I would close those because they're a waste. Now, since you're closing those for $1, now we have a more interesting thing though. So, what can we do with your position? You're in the 35s theoretically for $10. You can sell the 45s for $6, and then now you say, well, now I can take some of that money and use it to roll the 35s down to, let's say, the 30s. The 30s are $12.50, so you can take. So basically, now you're going to have an even better trade. So basically, you can take. You understand what I'm saying? So you take the 50s additionally, the 55s. You pay $1 to get rid of them. You roll them to the 45s for 6. So now you have net 5 of gain. You take half of that net 5, and that pays you to go to now the 30. So now you have the 30-45 spread. You have $250 in your pocket, and the short 28 puts. Or you could not even do the 28 puts, and because you're collecting all that money on the spread, that's your change in position. So isn't that easy to fix? All right, so I hope all that made sense. All right, guys. So I think we're about done. I got to get going and take care of some other stuff. But let's see. We'll take a quick look at the charts and see how they look. No changes, nothing exciting happening here. Barely, just about even on everything. I'm not changing my stance. I'm just not seeing enough new stuff. So you got to read what we're doing for the rest of the week. But I don't see enough evidence to say this is a rally. I just think it's a overall toppy action. And I think what's going on is that the people, people who have an interest in selling are just doing what they can to hold the market up. So whenever they have a chance, they push it up a little bit because that gives you a better price to sell. But it's not going to last. You see how it's flattening, this flattening action? Well, nicely up, not as up. It's very clear here. Up, loss of momentum, about half, and now we're basically just flatlining. This does not usually lead to another big leg up unless something spectacular happens. What this usually does is it leads to a sell-off. In the very least, we're probably not going to go anywhere until the 200-day moving average catches up to here. Then we're going to have a very, very big test. At this pace, though, from 200 to 240 in a month, you got to get to 280 to 300. I'm sorry, this is 2 months, 2.5 months. You're talking about June, July, August. You're talking about nearly September before this 200-day moving average is up to 2,100. You're talking about September. Until then, there's really not going to be a good catalyst to push us higher. If we do consolidate up here until September, that will be bullish, though. If we consolidate around here, staying above the 200-day moving average until September when the 200-day moving average catches up, that's going to be a good case for a bullish inflection point. The only problem, though, is while that's happening, the 50-day moving average is going to weaken and cause a death cross. So it's going to be really critical when we get to that point in September, because the 50-day will be down, the 200 will be up, and there'll be death crossing. Now, what's going to happen is at that point, the index is going to have to go up before the death cross gets steep, and hopefully it'll save the 50-day moving average and it'll pull up. Did that ever happen? Do we see that anywhere? No. But it can happen. Let me see. I don't know how well you guys can see this, but it's you see this little red line here? So pretend that's death crossing right here, right? And then you see how it gets saved? Because this guy's going up strongly. He's going down. That's the death cross below. But because the momentum is on the upside, he only very, very quickly goes under and then starts coming back up. Even so, though, the main index goes down. Even so, it still drops. So it's hard to save once you get into that situation. So what you're seeing here is going to be very hard to save unless either the market takes off shortly, by the end of the month starts taking off significantly over 2100, or if we go through a consolidation this summer, you're still always going to be a bias to the downside. Until proven otherwise, there's going to be a bias to the downside. All right, so that's what we're going to be looking at, and we will, of course, every week be able to touch base and check on it, all right? So thanks for coming, everybody. I appreciate it. Have a good weekend or good week.